The banking sector under pressure again this morning. Right now, the major money center banks are a little bit weaker. But of course, you should put this in context with what you're seeing in European banks right now. Right now, JP Chase down by about 1.9%. Bank of America off by 2.7%. Citigroup down by 2.8%. Wells Fargo and Morgan Stanley each down by about 2.33%. You're seeing different variations if you look at European banks. They're down by much more significant percentages. And joining us right now is Jason Goldberg. He's the managing director and senior equity analyst for Barclays. Jason, everybody's looking at all the banks trying to figure out what to make of any of this because this has been such a very quick moving story. What do you think this morning?
Yeah, no, there's certainly a whole host of uncertainties out there, whether it's over in Europe, or here in the States. The failure of Silicon Valley, just 2 weeks ago, it seems like months ago, has clearly, I think, created a lot of angst, throughout the financial services industry. In the U.S., a lot of the focus is just on, deposit flows at regional banks amid, depositors' concern of their balances at some of these institutions that either have a high percentage of uninsured deposits or relatively large unrealized losses on their securities portfolio, as a function of the higher interest rate backdrop.
So you cover the top 20 banks in this country. Have you changed your opinion on any of them over the last couple of weeks? Have you changed how you're viewing them, what you're looking into?
Yeah, no, certainly, there's, I would say, increased concerns around just the net interest income outlook for the group. I think it's important to know you kind of entered the year from a position of strength, right? Record revenues, record net interest income, historically low loan losses. But as you look out, expectations around deposits, both the level, particularly at the regional banks, the mix, in terms of higher costing, and just the overall rate paid on deposits are all likely going to be, more detrimental than expected at the start of the year and going to pressure net interest income. For the biggest banks, it's not as a meaningful driver. But for some of the regionals, it's the majority of what they do, and clearly it's going to affect expectations looking out. You're kind of a little bit in an information vacuum. We'll get earnings in like 2-3 weeks time to see ultimately, where these deposit levels shake out. But there certainly feels like there's been some movement away from some of the more regional banks into the biggest banks.
I mean, you've been covering the big banks for more than 25 years now. What does this rhyme? What does this rhyme like? Or what does this sound like to you? What does it feel like? Or is this one completely different and unique?
No, I think it is different. I mean, if you go back to 1994 when the Fed raised rates, fairly aggressively, that was only 250 basis points at the time. But, issues in Orange County, issue with derivatives like Bank One and Shawmut, and the likes, those stocks finished the year down 25%. Here the carry's been down, down 25% in a blink. So just the ferociousness that has come with us is, a bit surprising. But you think back to the financial crisis, that happened much more slowly, but that in that instance, a lot of the concerns were kind of, tied to losses on loans and assets that were truly needed to be marked down. Here, I think a lot of the concerns stem from unrealized losses on securities that most likely will mature at par. It's just they're long-dated, low-yielding assets, and the banks need time to work through them.
All right, Jason, thank you.
Thank you.